Auntie Eva,
Yes.
I hope you are seeing talk small, small.
I didn't join last week, but I'll catch up.
It is well.
Yeah.
All right. So let's come to working capital management. If they say working capital, what do you mean? We are just talking about how we manage our short-term resources, how we finance them, and how we manage them. So if you are talking about working capital management, you are talking about your short-term debts and your short-term resources. We are talking about basically current assets and current liabilities. How do we manage our day-to-day operations? How do we manage our inventory? Are we able to sell our inventory on time? Are we able to settle our liabilities on time? How do we manage it so that at the end of the day, our day-to-day operations will not be in a question mark or something? So if you talk about working capital management, you are talking about the capital that is made available for our day-to-day operations. And the component of the working capital are the current assets and current liabilities. Basically, trade payables or creditors, trade receivables or debtors, cash, inventory, overdrafts, and any of the short-term resources and short-term liabilities that you can talk about. But basically, what we are going to look at over here, excuse me. All right. Okay. So if we are talking about, sorry for that, if you're talking about the working capital management, we are just talking about basically the short-term resources and short-term liabilities. But for this particular team, what we are going to look at, we are going to look at how we manage cash, how we manage our receivables, and how we manage our inventory. The payables, we don't have enough issue about them. So how do we manage our inventory? How do we keep our inventory? Do we have a reorder level, or we wait till our inventory is out of stock before we order for them? How do we go about it? How is our minimal order level? Those are the things that we are going to talk about under the inventory. The receivables, what should we do so that people will pay on time? What do we do so that people will pay on time? You have to know that if you are giving them people a short time to pay, they will feel like you are only interested in the money, and pressure will be upon them. So as soon as they are able, they finish paying you, they might decide not to do business with you again. And if you're also giving them a longer period to pay, it means that some people might be out of business and some people, they might not pay. So the company will be writing a lot of bad debts. How do we manage our cash? We have to prepare cash budget. How do we invest our cash? When there is a cash, do we invest it? Where do we invest it? Those are the things that we are going to talk about. How do we manage them so that at the end of the day, everything will be efficient? Objectives of working capital management. Why should we manage our working capital? To ensure company has sufficient liquid resources to continue in business, minimize risk of insolvency. So if you are not managing your cash well, you are just spending your cash anyhow, and your current liabilities are going up. It means that when those current liabilities are due, you will not have money to settle them. So if you have a working capital management plan or policy in place, it means that anytime that you have any cash, you go and put it somewhere, or you invest it towards settling your liabilities at the day that they are going to fall due. So, but if you're not managing your cash anyhow, you get the money, you just spend it anyhow. You get the money, you spend it anyhow. If your liabilities are due, you will not have money to what? To settle them. If you don't carry out adverts to sell your inventories, there is no advert going on. Your inventories will just be there. If people like, they'll come and buy. At the end of the day, your inventories will be, your cash will be locked in inventory. All your cash will be in inventory, and your liabilities will be going up. You can't be able to sell or dispose your inventory on time to settle your liability. So how do we manage so that we don't lock up enough cash in inventory? Okay, let's do adverts. Let's do things so that our inventory, we can dispose our inventory as early as possible. How do we manage our receivables so that we will not incur a lot of bad debts? How do we manage our receivables so that we can be able to get money enough to pay our current liabilities? That is the issue of the working capital management. So we do this to ensure that the company has sufficient liquid resources to continue in business. Liquid resource that we are talking about over here is cash. We are talking about cash. Cash. We dispose if you are selling your inventories, you will receive cash. If you're also taking money from your receivables, it's cash. So how do you manage them so that we get cash, enough cash to settle our liabilities? To increase profitability, maximize return on assets. Maximize return on assets. Maximize return on assets. So we do this. If you are selling your inventory more, it means that your revenue will be increasing. But if you're not selling, it means that your cost will be going up. Your cost will be going up. Your inventory will be obsolete, and that will be lost. Your bad debt, you'll be writing a lot of bad debt, and you'll be paying more interest on failing to settle your liabilities. These are all costs for you, and that will reduce your profits. So these are the two objectives. We want to increase profitability, and we want to ensure that the company has sufficient liquid resources. If we are keeping more cash, it means that we won't be investing the cash, isn't it? If you are keeping more cash, we want to have more cash in hand. It means that we won't be investing the cash. We want to have more cash available. It means that you won't be investing your cash. You won't be investing your cash surpluses. If you're not investing, how do you get returns on it? So sometimes these two objectives will be in conflict with one another. You can't spend, you can't gain when you don't spend. That is the issue. So if you want to get more profit, you have to spend in more inventory, you have to buy more goods, but you also want to have enough cash with you, enough cash at hand. It means that you will not be able to buy more stock that will give you more profit. You will not be able to invest your cash into securities that will give you returns. So sometimes these two objectives, if you want to do, you can't do the two at the same time. You just do one and leave the other. Because if you are keeping more cash, it means that more cash will not be available to invest. If you want to increase profitability, it means that you'll be spending more cash to buy more goods, invest cash to get more return. So you can't have enough cash. So these two objectives sometimes conflict with one another. Let's look at working capital policies. Working capital policies. Working capital policies. Working capital policies. If you want to know the kind of working capital that you are going to, or the policy that you are going to set, depends on the nature of your operations, the nature of your organization operations. Depends on the nature of your organization's operations. All right. The first one that we have is conservative policy. Conservative policy. If you talk about conservative policies, what we are talking about is that okay, if you're talking about conservative policy, what we are talking about is that the company is trying to finance its non-current assets and its current assets through long-term finances, through long-term resources. So what we do is that our current assets and our current liabilities are being financed through long-term liabilities. So we go for long-term loans and we use it to buy our current assets and also our non-current liability. That is what we call the conservative policy. Our current assets and our non-current assets are being financed through long-term resources. Are being financed through long-term resources. If you come to aggressive means we are financing our current and non-current resources through short-term liabilities. We are using short-term finances to finance both our non-current and our current current assets. This is going to put pressure on the company, and this is going to make your current ratio and quick test ratio to be unfavorable, because the liabilities will always be, the current liabilities will always be higher than your current assets, because you are financing your current assets and your non-current liabilities through current liabilities. So this is very risky. This is very risky. It means that when there is an issue or the business they want to liquidate, they don't want to operate again, it means that all the short-term resources and the long-term resources will be taken over by the short-term resource, the short-term fund holders, or the current liabilities. People who are holding the current liability will take over all the non-current and the current assets of the entity. And this is it will even put pressure, because those people, since they are short-term, you will have to settle them on time. You have to settle them on time. So it will put pressure on the cash of the company. Whenever you get the money, the liability is due in 1 year's time, because this is a current liability. You have to pay within the shortest period of time. So as soon as you get some cash, then you use it to settle them. As soon as you get some cash, then you use it to settle them. This will put pressure on the operations of the company. And if care is not taken, the company might be out of business. But if you are using conservative policy, your long-term and your long-term assets, your short-term assets are being financed through long-term resources or long-term finances. It means that, okay, there will not be too much pressure on the operations of the company, because these people, we can take loans that we are going to pay in 30 years time. So we'll be paying them in a bit. And the interest that we are going to settle them to will be, maybe if you're able to use our resources very well, we can be able to settle their interest out of profit. We also have what we call moderate policy. The moderate policy is matching your short-term resources to your short-term debts and matching your non-current assets to what? Non-current liabilities. So we use short-term for short-term, long-term for long-term. That is how we do it. It's moderate. We just pick those that will be for short-term for short-term, long-term for long-term. And most companies use the moderate policy. So you can go to the exam. Working capital 2 is 15 marks. Sometimes you can get section A, which will be, you get theory, which will be 5 marks. They are here to bring questions on this working capital policy. Aggressive means you are financing your short and long-term resources through short-term debts. That is aggressive. Moderate means short for short, long for long. Conservative policy means short and long will be financed through long-term finance. That is the distance. Let's come to management of inventory, account receivables, account payable, and cash. We are going to focus on inventories, account receivable, and cash. Account payable, we don't have enough issue with them. Okay. Cash operating cycle. Cash operating cycle is just talking about how we spend our cash and how we get our cash back. How cash goes in, cash goes out, and how cash comes in. So if you have cash, we used to buy inventories, and these inventories will be turned to receivables, and receivables, we get our cash back. Or if we are buying these things, buying the goods on credit, then it means that we have our stock, or we have our creditors giving us stock. We have the stock, selling them to what? Customers on credit. That will be receivables, and receivables will now pay us with cash. So how cash is being generated? We take the goods on credit, then we have payables, we have inventories. Then these inventories will be sold to customers on credit. Then we have receivables, and these receivables will now pay us cash. So how cash is being generated? So if you want to, sometimes they can ask you the cash operating cycle. Calculate the cash operating cycle. The cash operating cycle is equal to the receivables collection period, which is in this, plus the inventory period, which is in this, minus the payables payment period, which are all in this. But the inventory, sometimes they can have all the types of inventory that we have. We have so many types of inventory. We have the finished goods. If you have finished goods, you calculate your period for the turnover period for the finished goods separately. If you have work in progress, you calculate it separately for them. If you have your raw materials, you calculate it separately for them and add the two to have your inventory period. That is not the issue. Let's look at also another activities that companies undertake in terms of working capital management. The first one is overtrading. Overtrading means you want to achieve more with a little that you have invested. You want to achieve more with a little that you have invested. You are overtrading. You have only invested 10,000 in your resources, but you want to generate a profit of maybe 100 million. No, that is too much. So trying to generate much profit with a short or with a small investment in assets. No, you are going to overuse your assets. You have to know that if you are overusing your asset, the efficiency of the asset will reduce. So overtrading has to do with you putting small in your asset, doing small investment in your asset, and you are trying to increase your profits. It means that you are going to overuse your assets. So sometimes they can ask you, what is overtrading? Overtrading is trying to achieve much with a little investment in your capital. Trying to achieve much with a little investment in your capital. What are the symptoms of overtrading? Sometimes they will give you a financial position and ask you to analyze whether the company is overtrading or not. If you want to know that the company is overtrading, the first thing that you have to do is that what is the investment? What is the change in the asset, in the long-term asset? What is the change in the long-term asset? Look for the change. Then you now come and look at what is the change in your gross profit margin, or what is the change in the revenue. If the change in the revenue is very high, it means that you are using little resources to generate the growth in the revenue. So if you talk about symptoms of overtrading, we are talking about rapid increase in turnover. So they will give you maybe financial statement for 2 years, and they will ask you to analyze whether the company is overtrading or not. How do you do this? Go and look for the change in the long-term assets. What is the change in the assets? Look for the change, the value. Is it 10,000? Then you now go to the revenue. Compare the revenue. The increase in the revenue, can we say that it is normal for the investment made in assets? If it is too much, if it is abnormal, that means the company is trying to achieve much with a little. They are overusing the assets, and that is overtrading. Rapid increase in the volume of current assets and possibly also non-current assets. Higher inventory and accounts receivables period. Okay. If you also see that there's only a small increase in equity capital, most of the increase in asset is financed by credit, especially. So if you are seeing that your assets are being increasing, but your equity capital is small, where is the money coming from? You can also say the company is trying to do what we call, if you have a higher bank overdraft, we can also see you are doing what we call overtrading. Some debt and liquidity ratios alter dramatically. So you see that a debt to equity ratio and those things are abnormal. They are abnormal. Current ratio and quick ratio are falling. It means that there is not enough investment there, but you want to increase your revenue. Business might have a liquid deficit, an excess of current liabilities over current assets. Sales or working capital ratio is increasing over time. These are the symptoms of overtrading. So if they give you financial statement, go and do maybe 2 of this. Look at the trade account payable. Are they increasing, or is the ratio, is their days increasing? If their days are increasing, it means that the company is overtrading. Look at the debt and liquidity ratio. What can you say about it? Are they increasing or they are reducing? current ratio. If the current ratio and quick ratio are falling, we say the company is over trading. What's the solution to the over trading? The solution is the project that you want to undertake. You can decide to avoid it. You can decide to postpone it. The project that you want to undertake, before you are investing small to increase your revenue, you are investing small to have a higher return. You can postpone that particular project. So one of the solutions is postpone the project, or you inject enough capital for the project. So go and set for the capital, the actual capital required for the project, and put it into the project. So you inject enough capital into the project. That is another solution. Or you postpone the project. You can also finance the growth through long-term loans. So the new capital could be injected from shareholders. So you can raise enough capital to finance the project. You can also finance the project through long-term loans. Better control could be applied to management of inventories and account receivables. The company could postpone ambitious plans for increased sales and fixed assets investments. So you can decide to raise more capital from the shareholders. You can decide to finance the project through long-term loans. You can also decide to postpone it, or you can also apply better management to manage your inventories and accounts payable. They can ask you what is overtrading, symptoms of overtrading, at least give 4, and you give solution to it. So pay attention to this. Let's look at what we call overcapitalization. Overcapitalization. Overcapitalization is the opposite of overtrading. You are investing much, but you are getting less return. You are investing much, but you are getting less return. Overtrading means you want to get more with a small investment. But overcapitalization is the opposite. You are investing more and you are getting low return. So if there is excess inventories, accounts receivable, and cash, and very few accounts payable, there will be an over investment by company in current assets, and the company will be in this respect over capitalized. So you are having more of your current assets, and current asset must be financed through current liabilities, but you're having a small current liabilities and you're having a higher current asset. We are saying that you are putting much into the current asset, which is not matching the current liabilities, because current liabilities has to be financed with current assets. So if your current assets are higher than your current liabilities, we say you are overcapitalizing. Or if you're investing more to get lower returns, you are overcapitalizing. Let's look at inventories management. Let's come to inventory management. This is why we are here. If you are talking about inventory management, how often do we sell our inventory? Or what is the day? The time that we receive the inventory to the time that we are selling it. How long does it take us? So we want to look at the inventory period. We want to do this so that most of our inventory will not be obsolete. By passage of time, our inventories will become useless. You have a software that the softwares are there, and now there's a new software. The old software will be useless because you're not managing them well. You're not doing adverts to dispose them. Your inventory turnover period is big, or is too much. It is making you not to sell or dispose your inventory over time. So if you are doing that, most of your inventories will become obsolete, and that will be a cost to you. So how do we do that? We carry out adverts to dispose our inventory, or we try every means possible to reduce our inventory turnover period. So if you talk about inventory management, we are talking about reduce stocks to the lowest possible level, hence reduce the working capital. Ensure that sufficient stock is available to avoid stock outs. So what we do is that we set a reorder level. If our inventory reaches this level, then we need to reorder. We need to buy additional inventory. So sometimes we can have reorder level, or sometimes we can have a buffer stock, or a buffer stock, which is something that we call a safety stock. Something that we are saying that, okay, we have a reorder level because of the demand from the customers. Maybe the reorder level is not much. So let's add a situation where let's move provision for something that might happen. The reorder level is 15,000, but we can reorder. We can order and get the goods at that time. We are going to have a lead time. The time from the order, the time that the order is placed to the time that the order is being received. If it is taking us 2 weeks to receive the goods after the order. It means that if you're having 15,000, some people might come that they want 17,000, and you will not have the 2,000 to sell to them. You can only give them 15,000. Okay, so there might be a situation where people will come and say they want their demand is higher than the reorder level that we have, the stock that we have. So let's add a margin that will take care of those situations. That is the safety or the buffer stock. That is the safety or the buffer stock. If we talk about inventory management, we are going to buy the inventory. If we are buying the inventory, we are going to incur what we call purchase costs. If we are ordering the goods, we can have ordering costs. Maybe the processing, we are going to process paper, everything, the process and everything that we are going to do will cost us. That is the ordering cost, the cost that we incur to order goods. Or the transportation can also be ordering cost. Before, if you order the goods, they will transport it and bring it to you. That is a cost that you are incurring as a result of you ordering the distance. So transportation and all those things will come under the ordering cost. The processing of the paper, the signing and all those things, printing and all those things will also come under the ordering cost. The cost that you incur to order goods or receive the goods is the ordering cost. You can also have what we call holding cost. Holding cost has to do with you putting the goods in a warehouse. So if you have the goods there, you are going to pay rent. Warehouse, you are going to pay rent. Maybe if it is not your place, you are using someone's, this one, you pay rent to the person. You can also incur something that we call the storage cost. Some of the goods might go bad. That is a cost to you. And any other cost that you are going to incur for you keeping the stock in a better position. So if you talk about inventory, these are the costs that are associated with the inventory. These are the costs. They can ask you in the exam, what is ordering cost? Give 2 examples of ordering cost. Ordering cost is any cost that you are going to incur for an order place for a material, or the cost that you are going to incur from the time that you order the goods to the time that you are going to receive the goods. This may include transportation cost, which is the delivery cost, which may also include maybe administrative costs like processing of the order and those kind of things. They can also ask you holding costs. Holding cost is the cost that you are going to incur for you storing the goods until they are needed. The first thing is the storage cost. Sometimes the material handling cost, you have supervisors there, they will go and they will supervise. So you can also have a supervision cost. You can also have the insurance cost if you are insuring the warehouse. If you insure the warehouse or you insure the warehouse, it means that you are insuring the warehouse because of the goods over there. Because of you holding the goods over there, because you are thinking that anything can happen to the goods. There can be a fire outbreak and the company has to reimburse your money back to you. So we have the insurance cost. Okay, let's look at what we call the stock out cost. The stock out cost relates to the cost or the profit that you are going to, the profit that you will not be getting, or the profit that you'll be losing when people come with their demand, but you don't have any goods available to give to them. So if you are there, people will come. You have stock, which is 15,000. People are looking for 17,000. 17,000. It means that you don't have 2,000. So if you should have that 2,000, what will be the profit that you get on the 2,000? And that is the stock out cost. The contribution loss is the stock out cost. But in this discussion for inventory, we are going to be basing it on purchasing cost. The purchasing cost is the cost multiplied by the number of items that you purchase. So they will give you the cost per unit and you multiply it by what? The items, the number of items that you have purchased. The holding cost, we have a way of calculating it. The ordering cost, we also have a way of calculating it, which we are going to look at very soon. All right. Okay, these are the inventory levels. So I hope you all know about reorder level under the material valuation model. We under inventories, cost accounting. We have the inventory levels. We have the reorder level. This is the level that at which if our stock reach that level, we should place a different order. That is the reorder level. So how do we calculate it? Okay, what is the highest demand for the period? What is the highest demand? We just use our highest demand to multiply our highest lead time. The lead time is the time the order is placed to the time that the goods are what? Are being received. You can't be taking the minimal demand, because we are saying that if people didn't place the order part, it is between 1,000 to 2,000. You can't be ordering for 1,000. No, people can come and say they want 1,005. So it is better you order for the maximum. It is better you order for the maximum. But whenever you order, it will take you 10 to 20 days. You can't be saying that people will supply the goods in 10 days. No, it can happen that they will supply within 15 to 20 days. So take the maximum. That is what we do. So the maximum usage or the maximum demand time is the maximum lead time. Minimum or maximum reorder level. These are not related to, this is cost accounting. These are not related to our discussion, management accounting. All right. What we do is that at what level must the entity order? At what level must the entity order for additional units that will help the entity to reduce cost? So we are saying that reorder level might be there, but at that reorder level, we might be incurring enough costs from the ordering or anything that we want to do. So what level that will give us a minimum cost? What level should we order? What level should we order? Every order, what is the quantity that we should place per order that will help us to maximize our costs? That is what we call the economic order quantity, or sometimes they call it the optimal level. The optimal level. So if you are talking about economic order quantity, we are talking about the quantity of goods that we should place.
Hello, sir.
Yeah.
I think he said maximize our costs. Oh, I didn't get that part.
To minimize our costs.
It's minimize rather.
Yeah, minimize our costs. So how can you maximize costs? Then it should be to minimize costs. We want to reduce costs, so we can't be doing that so that we want to increase costs. No. All right. So at what level should we order, or how many quantities should we place per order? Anytime that we are ordering, how many quantities should we order? And this quantity will help us to reduce any cost that will be associated with the ordering or the purchase or anything. That is the economic order quantity. That is the economic order quantity. So an economic order quantity is a reorder quantity where the total holding cost and ordering cost is minimized. At economic order quantity, annual holding cost is equal to the annual ordering cost. What are the assumptions that we make under the economic order quantity? We assume that the holding cost and the ordering costs are going to be constant throughout the year. We also assume that the demand will be constant throughout the year. In practice, this is not the same. Sometimes the ordering cost might be different because of inflation. The demand might change. If you are ordering now, you have a higher demand for the goods. The demand might change. Maybe after you have ordered 60,000 for the first half, the second half might be 8,000 or must be 80,000 because demand has increased. But for economic order quantity, for the purpose of computing economic order quantity, we assume that holding cost is constant, ordering cost is constant for the year, and annual demand is also what? Constant. How then do we calculate the economic order quantity? The economic order quantity is equal to the square root of ordering costs multiplied by the annual demand, or divided by the holding cost. So the question will give you the annual demand. Sometimes they will give you units. We place the order for raw materials, not finished goods. What we are doing over here is that for this one, we assume that the entity is a manufacturing entity. They are producing and selling the goods themselves. So we place the order for raw materials, not finished goods. We place the order for raw materials, not finished goods. We place the order for raw materials, not finished goods. Let me show something. Okay. So what will happen is that they can give you that the entity need 2 kilogram. The entity uses 2 kilogram to produce one quantity of the finished goods. So they will give you 2 kilogram. The material requirement is 2 kilogram, and the annual demand for the entity finished goods is now 20,000 units. For you to know the annual demand for the material, you multiply the material requirement by the unit that they want to produce. So 1 unit, we are using 2 kilograms. So if you are using 10,000 units, it means that our material demand will be 20,000 kilograms. It is the 20,000 kilograms that we are going to use as the annual demand, not the finished goods. We don't order for the finished goods. We assume that we are producing and selling by ourselves. So we normally do the economic order quantity for raw materials, not finished goods. Sometimes the question can give you the finished goods and they will give you the material requirement. Multiply the material requirement by the annual finished goods that the company is producing. Then you have the annual demand for the raw material. We do this for the raw material, not the finished goods. We do this for raw material, not the finished goods. All right. Okay. So this is the economic order quantity. Square root of this. These formulas will be given to you in the exam. Square root of this and this. That is all. How do we calculate the annual holding cost? Yeah, I will. Okay. Okay. All right. So our order, every order is 20,000. So every order that we are going to make is 20,000. It means that maybe this is what we are holding, but this, since the order is for a year, what we do is that we just find the average. So we take our economic order quantity. The annual holding cost is the economic order quantity divided by 2 times the holding cost per unit, multiplied by the holding cost per unit. So annual holding cost is the economic order quantity that you have calculated divided by 2 times the cost of holding. If our annual demand is 20,000, but every order we are going to place, we place 1,000. So how many orders are we going to place to have the 20,000 units? Every order that we place is 100,000 kilograms, but our annual demand is what? 20,000 kilograms. So how many orders are we going to place within the year to have the 20,000?
20.
We have 20. So our ordering cost is calculated as the number of orders times the cost per order. How do we get that? If your annual demand is 20,000 and every order is 1,000, every order is the economic order quantity is 1,000. You just divide the 20,000 by 1,000. So ordering cost is equal to the annual demand divided by the economic order quantity times the cost of ordering. The cost of ordering. That is how come we used to get this. So sometimes they can ask you to find the total cost of the inventory. The total cost will be the purchase price, which will be given to you, multiplied by the quantity that you are buying, plus the holding cost. How much is it going to cost you to hold? And how much is it going to cost you to order? These are the costs, these are the total costs that are going to incur relating to the inventory. So sometimes the question will give you that. All right, let's look at this. We pick 2 questions on this one, then we move on. Before I will say something, if you are doing the holding cost, we consider what we call the buffer stock or the safety stock. It means that if your ordering level is 15,000 and you are now saying that you are having 17,000, it means that you are holding additional 2,000 there above the ordering cost. The ordering cost is okay, if this thing reach this level, we are going to order, but you are holding additional 2,000 for it, so that maybe something might happen, and this you are going to incur cost for this holding inventory, which is 2,000. So if you are calculating the holding cost, if there is a buffer stock, you use the buffer quantity to multiply the holding cost per unit. We add the buffer cost of holding the buffer inventory, which is the safety inventory. We add it because that is additional cost that you are going to incur for holding that particular stock. So we add a buffer stock to it. That thing nearly escaped me. Okay. Where there is a bulk purchases, sometimes the company will say that if you order this level, we are going to give you discount of this. So what will happen? Do you want to take the discount or you want to ignore the discount? So the quantity that the entity is giving to you now is now the new order quantity. So you calculate your cost for the original thing that you are doing, then you calculate your costs for what the company is giving you now. You compare the two. If buy in bulk or taking the discount to give you small cost or lower cost, then you take it. But if it will give you a higher cost, then you will still be ordering what you are ordering. You are going to pick a question, then you look at that. You also have what we call just in time. Just in time means you are not keeping any closing inventory. You buy or you produce when there is a demand. You buy when there is a demand. You buy the quantity when there is a demand. You produce when there is a demand for it. You are not keeping any closing stock. That is what we call just in time. But this just in time is only efficient or effective when you have a reliable source of supply. So when you have people that whenever you call them, you get a goods, you can operate just in time. But when your supply sources are not reliable, if your supply sources are not reliable, you can call the people, they say, okay, they don't have enough stock. You can't operate just in time. You will be losing demand, you'll be losing money, you'll be losing customers. So this just in time means you only order when there is a demand. You are not keeping any inventory, you are not keeping any stock. You only go and buy and produce to the people. So that is what maybe some of the restaurants they do. You go there, they say a minute, before you know 30 minutes has passed. They only cook when there is a demand. But it doesn't mean that they don't have inventory. They have inventory. But if you're operating just in time, it means that you're having a zero closing stock. You just go and buy based on the quantity that people are demanding and manufacture for them or produce for them. That is the just in time. But just in time is only reliable or is only efficient and effective when you have a reliable sources of supply or you have a numerous sources of supply. That is what we call just in time. An alternative view of stock management is just in time, in which stock level is either reduced or eliminated. Since stock is seen as waste, organization order the material when it requires production. Implication of the just in time. When there is supply saying that they don't have, your demand will not be those things. So the implication will be there is a higher dependency on the supply for both quality and reliability. You don't have stock, so you are going to rely on someone that should supply. If the person fails you, that is the end. These things are not necessary for me. Let's look at how we do payable management. Is not anything. We are even done. Let's move on. Let's look at questions for receivables. Let's look at questions for receivables. Let's see if we can get questions and do it on receivables. Why I'm not getting any question on receivables? Okay, let's try the question 6. Okay, let's try another question before the question 6. The question 6, if I should start the question 6 with you, it will be some way. Okay, let's try question. Let's solve 3 questions on this. Question 11D. Question 11D. Question 11D. Question 11D. Can we see the question 11D? Question 11D. Can someone see the question 11D? Who is reading for us? Habakkuk, read for us. Brain, are you there? Austin.
Hello.
Yeah. Austin, read. I'm sure that Habakkuk is not there. Question 11D. Let's try that one before we move on to.
Okay, I can see with only the requirements, so maybe if you can tune up.
You can see only the required.
Yeah, required.
Okay. Can you see D?
I can see cost of app as well.
Can you see FLG Co wishes to maximize its inventory cost?
Current asset. I see only the current assets side.
Question 11.
Yeah, I can see now.
Can you see the D part?
Yeah, I can see the D part.
Okay, read the D part. Let's move on.
Okay. FLG Co wishes to minimize its inventory cost. Annual demand for raw material costing 12 cedis per unit is 60,000 units per year. Inventory management costs for this raw material are as follows. Ordering cost 6 cedis per order. Holding cost 0.5 Ghana cedis per order per unit per year. The supplier of this raw material has offered a bulk purchase discount of 1% for orders of 10,000 units or more. If bulk purchase orders are made regularly, it is expected that annual holding costs for this raw material will increase to 2 cedis per unit per year. Required. Calculate the total cost of inventory for the raw material when using economic order quantity. Determine whether accepting the discount offered by the supplier will minimize the total cost of inventory for raw material.
Okay. Okay.
Yeah.
All right. So what we do is that for us to know this, mostly what we do is that how many quantities should we order? Per every order, how many quantities should we order? So that we can minimize costs. So we first thing, if you are giving this question, they can also find total cost of inventory. But before you can find the total cost for inventory, you need to know the quantity that you are ordering per order. Every order, how many units are you ordering for? How many units are you ordering for? They are saying that our annual demand is what? 6,000, isn't it?
Yeah, 60,000.
50,000. And
Yeah.
our cost per order is what?
Cost per order is 6 cedis.
Okay. And our holding cost is what? 0.5 per unit per year. So if you don't know the number of orders that we are placing, can we find the ordering cost? No. If you don't know the quantity that we are ordering per order, we can't find the holding cost too. So always you are giving question on this. If you are not giving the quantity that the entity is placing per order, you have to find the quantity that they will place per order to minimize cost, which is the economic order quantity. So the first thing that you have to do is that calculate the order that you are going to, the quantity that you'll be placing per order, which is the square root of what?
The square root of
Mind.
2,
D
Two,
times
two.
The 2 come first.
2 times 2
Mhm.
times cost of order times demand
Okay.
all over.
Holding cost.
Yes.
All over the holding cost. So I want to see whether I can put my formula here, but I can. Excel cannot take formula. So do it on your calculator.
You get 1,200.
It will be 2 times what? The annual demand. Sometimes they can give you the demand per month. So if they are giving demand per month, what will you do?
Multiplied by 12.
12. We are looking for annual demand. Annual demand. So if you are giving weekly demand, multiply it by 52 weeks. If you are giving daily, multiply by 365 to get your annual demand. We always use the annual demand. Times the ordering cost is 6 times the annual demand, which is what? 60,000.
50,000.
Then all this divided by the 0.5. Then you find square root of the answer. What is the economic order quantity?
1,200.
1,200. So economic order quantity is what? 1,200 units. Okay. They say we should find our total cost of inventory. So the total cost of inventory, the first cost that we are going to incur is the amount that we are paying for it, isn't it? All right. The first cost is the amount that we are paying for the inventory, the amount that we are purchasing the inventory. That is the first cost. So the total cost of the inventory is calculated as the purchase cost. What would be the purchase cost? The purchase cost is the cost per unit multiplied by the number of quantity that we are buying. So what is the cost per unit?
6
No,
is 12.
the cost per unit is 12 times the
Yeah.
quantity. How many quantities are we buying?
60,000.
60,000. So what will be that?
720,000.
20,000.
300 what?
720.
Okay.
720.
720,000. Okay. The next cost is the cost that we are incurring for ordering. So the next one is the ordering cost. The ordering cost. The ordering cost is calculated as the annual demand. What is our annual demand? It's 60,000, isn't it?
Yes.
But per every order, what is the quantity that we are ordering? 1,200. So how many orders can we place? If one order is 1,200, so how many orders can we place to get our 60,000? So for you to do that is the annual demand divided by the economic order quantity. How many quantity are you getting?
65.
60 divided by 1,200 times your ordering cost. Cost per order, which is 6. So you are going to place order. You are going to place order 5 times before you can get your annual demand for what? You are going to place order 5,000 times, isn't it? You place the order 5,000 times to get your annual demand of what? Is it 5 or 5,000?
It's 50.
50.
It's 50. Okay, I'm
So
doing
it's-
12. Okay, you are going to place order 50 times before you can get what? The 60,000 as the annual demand. But every order is 1,002. So how many times can you place order for 1,002 to get your annual demand for 60,000? It is the
50.
annual demand divided by the economic order quantity times
Cost per
the
order.
cost per order. How much are we getting?
300.
300.
We are getting
Minus
300. Okay. Let me take this and bring it here. That will give us 300,000, right?
Yes.
Is it 300 or 300,000?
300.
300.
Just 300.
Just 300. Okay.
Mm.
Let's count to holding cost. Holding cost. Holding cost is calculated by the economic order quantity divided by 2 times the cost per unit. So we find the average order. We find the average order, then we multiply it by the holding cost per unit. So the holding cost over here, they can also give you per month. The holding cost should always be per year. They can give you per month. So you multiply 0.5 by what? 12. Are you okay?
Yes.
All right. So we have, what is our economic order quantity?
1,200.
Divided by 2 times what? 0. What?
5.
0.5. How much are you getting?
300.
300. So our total inventory cost is now what? The purchase price plus the holding cost plus the what? The ordering cost.
720,600.
Okay. Okay, 720,600. So this is our total inventory cost. Okay. So this is the I part. Okay. But what are they doing right now? The supplier is saying that we should do what? The supplier of this raw
To
material has
purchase any
offered
purchase.
a bulk purchase discount of what? 1% for orders of 10,000 units or more. If the bulk purchase orders are made regularly, it is expected that annual holding cost for this material will increase to what? 2 CD per unit per year. So if we are taking the order, what will happen right now is that our holding cost will what? Will increase.
To
Our
increase.
holding cost will increase. But the question now is, what is now the economic order quantity for the offer given to us? How much are they saying that we should now place per order?
10,000.
10,000.
10,000
So
units.
if
So
right now our 10,000 is the unit that we are going to place per order. So this is now the economic order quantity for us. Sometimes they can give you that you should place order between 500 to 800. Always take the smallest one. The supplier will tell you that if you place order from this to this, then they will give you a discount. Just take the smallest one. Are you okay? Because if you are taking
Okay.
the highest one, your cost will increase. So we normally sometimes they can give you a range. Pick the smallest one. Pick the smallest one. All right. So in this case, the supplier of this raw material is saying that if we can place 10,000 per order, 10,000 for every order, they will now give us what? 1% of the what? The purchase price. But this will increase our what?
holding
Our
cost.
holding cost to 2. So let's come and find the cost for the offer. Let's find the total cost for the offer. Total. So if you want to know whether you accept it or you keep doing what you are doing, you find the cost for the first thing that you are doing, which is the quantity that you are ordering yourself, and you find the total cost for what the supplier is telling you now, the terms that the supplier is giving to you now. You compare the two. If what you are doing seems to be more favorable than what they are giving to you, you continue to do your own thing and reject the offer. Are we okay? All right.
Yes.
Sometimes what happens is that the supplier will not give you a discount. The supplier will not give you a discount, but they will just say you should supply this. So what will happen is that if in this case they are not giving a discount, it means that your purchase price will still be 12. So sometimes we ignore the purchase cost because it's not going to have any effect. It will be 720 for the 2. But this case, the purchase price will no longer be 12. It will reduce by 1%. So what do? We have our purchase price, purchase cost or purchasing cost will be equal to what? What will now be the new price will now be 99 times 12, isn't it? 99% times 12. Am I correct?
Yes, you are.
We are taking discount of 1%. It means that
1% out.
we pay 99% of that. So 99% of the 12 cities
For
multiplied by the quantity that we are buying. The annual demand will still be the 60,000, but they are just giving us how we should order for it. How we should order for it. For every order, let's place order of 10,000. It doesn't change the fact that at the end of the day, we are going to have 60,000 units. Are we okay? All right.
Mhm.
Times 60,000 units. How much are we getting for this one?
712,800.
700 and
12,800.
12,800. Okay. Always, if you are increasing the order size, the ordering cost will reduce and the holding cost will increase. Okay. So what will be our order size now? It will be 60,000 divided by our
Right.
new quantity per order, which is what?
10,000.
Am I
10,000.
10,000? All right. Multiply by what?
Cost of ordering.
Which is 6 cities.
6 cities.
Eva, are you okay with this one?
Yes, I'm following.
Joycelyn, are you there?
Yeah, I'm here.
Are you okay with the ordering the second ordering cost?
I'm following.
Are you okay? I'm not saying whether you are following or not.
Okay, I'm not okay. I'm not okay.
With this one, with the one that we are doing or the first one.
The second one.
Okay.
I got it up to the purchase cost, so the
Okay.
ordering cost.
The ordering cost, what they are saying is that the supplier is not telling us that if we are able to place order, of 10,000 units, they are going to give us a discount of 1%. So it means that they are not telling us that instead of us placing order for 1,002 per every order, let's now increase our order size to 10,000. So for every order that we are going to place, we are going to order 10,000. So for every order is 10,000. It means that they are now changing our ordering level to 10,000. But we need 60,000 as the annual usage. But they are saying that every order that we are going to place, it should be 10,000 units. So how many orders can you place to get the 60,000 if every order is 10,000?
6.
That will give you 6. So this is the same as 60 divided by 10, which is 6 times the ordering cost. That is what we are doing. Are you okay now?
Okay. Yeah.
Okay, let's move on. So what are we getting? 36.
Yeah, 36.
Okay. Let's come to holding costs. Our holding cost will now increase to what? 2 cities. But what will be the average now? Now our order is what? 10,000. So the holding cost is the units per order divided by 2 times the ordering cost. So now our ordering level now, or our order size is now 10,000. So 10,000 divided by 2. So 10,000 divided by 2 times the new holding cost, which is what? 2 cities. So how much are we getting?
10,000.
10,000. Okay. So let's find the total for this.
Sir Linus,
Yeah.
please, is the discount not going to affect the holding cost?
No, for this one it will not affect because they are not giving us the discount. They are giving us the holding cost. It will only affect the holding cost when you are calculating the holding cost based on the purchase price.
Mm.
Okay. When you are calculating the holding cost, I wanted to say it best. I forgot it, but we are going to solve example, so something might come like that. The things are plenty in my head. So if you are calculating the holding cost, sometimes they will say the holding cost is 10% of the purchase price. Okay. So if the holding cost is 10% of the purchase price, it means that the first one will be 1.2, isn't it?
Yeah.
It will be 10 times 12. That will give us 1.2 as the holding cost. But now the purchase price has reduced by what? 1%. So what will now be the new purchase price? It will be 99% times 12, isn't it?
Yes.
Okay. And that will give us what?
11 cities. 11.88.
Okay. Now we now calculate our holding cost based on this new amount as the 10% of this amount. So we now apply the 10% on a new purchase price, and that will give you the holding cost, which is 1.188. So the holding cost only reduces when you are calculating the holding cost on the purchase price. So if the purchase price reduces, it means that the new holding cost will also reduces. So let's see whether we can get example like that and we move on. Eva, are you okay now?
Maybe when we solve the second question.
No, the holding cost is given to us now. Our holding cost, this expected our annual holding
The
cost.
holding cost is now giving us 2 cedis.
Yes.
But we have a discount of 1 cedi.
No. The discount will not be
1%.
the discount will be 1% based on the purchase price. It is the purchase price that they are giving us the discount on, not the holding. The holding cost is the cost that we are incurring.
Okay. So it is on the purchase price.
The discount is on the purchase price. If
Okay.
you are calculating the holding cost on the purchase price, it means that as far as the purchase price reduces, the discount will also what? The holding cost will also what? Reduce. But this one, they are now saying that if it is expected that the annual holding cost for this raw material will increase to 2 cedi per unit per year. So this is now our new what? Holding cost, 2 cedis. Are you okay?
Okay.
Are you okay?
Okay.
All right. So the holding cost has not, we are incurring the holding cost. It has nothing to do with the supplier. If we are keeping the inventory in stock, the supervision and everything, the storage cost and everything is 2 cedi per unit. The supplier is not going to do anything to it. Supplier is only going to give discount on the purchase price. All right. But if you are calculating the holding cost on purchase price, that is where the discount will affect it. All right. Should we take the offer?
No.
Should we take the offer?
No.
Okay. So we are going to reject this offer. Determine whether whether discounts offered by the supplier will minimize the total inventory cost for the raw material. No, it will increase it. By how much? What will be the increase?
22,236.
Okay. Let's pick another question. Then let me see what we do. Then we say we are done with inventory. Oh, I don't want to. Oh, this buffer thing, I don't want to get it just like this. Okay, let's take the question 15A. Question
Okay.
15A.
WQV.
Question 15A. Okay.
WQZ Co is considering making the following changes in the area of working capital management. A. Inventory management. It has been suggested that the order size for product KN5 should be determined using the economic order quantity model, that's EOQ. WQZ Co forecast that demand for the product KN5 will be 160,000 units in the coming year, and it has traditionally ordered 10% of annual demand per order. The ordering cost is expected to be 400 cedis per order, while the holding cost is expected to be 5.12 Ghana cedis per unit per year. A buffer in inventory of 5,000 units of product KN5 will be maintained, whether orders are made by the traditional method or using economic order quantity model.
Hold on. Let me go to the down so that you can read the requirements for the inventory. We are looking at only the inventory. Sometimes they will give you inventory, cash, and also receivables. But we are doing only inventory. So let's consider the inventory first. Austin, are you Are you going to the MA videos?
So far, what I go through is the FM.
Okay.
For the MA, I work the contemporary and budgeting. I have not checked the others.
Okay. Let's do the read the A. The A is talking about the
Calculate the cost of the current ordering policy and the change in cost of inventory management that will arise if the economic order quantity is used to determine the optimum order size of product KN5.
okay. Sometimes they will not ask you to calculate the economic order quantity, or they will not ask you if the entity is using economic order quantity. They will ask you to calculate the optimal order size. The optimal order size. The optimal order size is just the order that we should make that will minimize our cost, which is the same as the economic order quantity. All right. What are they saying? It has been suggested that the order size for product A should be determined using the economic order quantity model. WQZ Co forecast the annual demand for products KNG will be 160 units in the coming year, and it has traditionally ordered 10% of annual demand per order. So what is their current order size? What will be their current order size?
10% of the 160,000. So
That will give us how much?
16,000.
Okay. So right now, currently, what they are doing is that they normally order 10% of their annual demand. Every order, they do 10% of the annual demand. What is the annual demand? 160,000. So 10% is 16,000. So currently, their order size is 16,000 per order. 16,000 per order. Okay. The ordering cost is expected to be 400 per order, while the holding cost is expected to be 5.12 per unit per year. A buffer inventory of 5,000 units will be maintained, whether orders are made by traditional method or using the economic order quantity model. The requirements: calculate the cost of the current ordering policy and the change in the cost of the inventory management that will arise if. So what we do is that we are going to compare the current policy that they have for the inventory, and if they want to change it, what are the costs? We compare the two, then we know whether they should change the policy or not. So if you have a question that they are saying that this is what they are doing currently and this is what they have to do, you find the benefit or the cost associated with what they are doing currently, and you also find the cost or the benefit associated with if they change to what they want to do. So we look at the cost for the current policy. So cost under the current policy. Cost under the current policy. Cost under the current policy. Then we have the purchase price or purchase cost. Purchase cost is what?
Purchase cost.
Are we giving a purchase cost in the question?
No.
Are we giving a purchase cost?
No.
No.
No,
So we
please.
assume that the purchase cost, whether it is economic order or it is a traditional order, they are going to pay the same amount. If it is 12 cedi, to be 12 cedi for the two, no discount, isn't it?
Mhm.
So the purchase cost will not be relevant here. If we are doing the current one, the cost is 12 cedi, and we are ordering 160,000. Okay. If we are buying under the current policy, we are going to pay 12 cedi for every unit of 160,000, isn't it? So our total cost will be 12 times 160. If we are changing the policy that we are changing will not affect the price. What it will affect is the ordering size that we want to change. Is the ordering size that you are going to change. So the change will only affect the ordering cost and also the holding cost. Whether you are changing it to economic order quantity, you will still buy the things at 12 cedi and you buy the 130. But the quantity that you are going to order or per order, or the quantity that you are going to be ordering for every order is the one that is going to change, not the purchase price. So when you are not giving any information, you don't consider the purchase price, because it will be, if it is 12 cedi, it will be 12 for the current and then the 12. The price will not change. The price will only change when you are giving a discount. But in this case, it's not the customer, it's not the supplier that is giving us a discount. We just want to change the holding or the ordering size. If the ordering size is changing, it means that the holding cost will change and the ordering cost will change, but the purchase price will still be the same because we pay the same amount. So we have the ordering cost will be equal to the annual demand. What is the annual demand?
The annual demand 160,000.
And what is our current order size?
Sorry.
10% of the annual demand, isn't it?
16. Yeah.
That'll give us
16,000.
16,000 times the ordering cost. What is the ordering
Okay.
cost?
The
100.
ordering
400. How much are we getting?
4,000.
We are getting 4,000.
Yes.
Okay. Let's come to the holding cost. Holding cost is the what? The ordering size divided by what? 2, isn't it?
Here.
So what is our ordering size now?
4,000.
No. That
Is
is
the
ordering cost.
economic
Is the order size. Order
So
size
that is
divided by 2.
16,000.
The order size is what?
16,000.
16,000. So is the order size. How many quantity are we placing per order? So under this question, our economic order quantity over here is 16,000. That is the amount that we are placing per order. So this over 2 times the holding cost. What is the holding cost?
5.12.
So
5.12. How much are we getting?
4960.
40,
960.
960. Okay. What will be the total cost for this?
44,960.
44,000. Okay. So this is the current policy. Let's look into the new policy now. The new policy.
Please, so
Yeah.
the holding cost is the economic order quantity,
Yes.
or the quantity to be demanded over 2.
It's economic order quantity, which is the order size. The economic order quantity is the quantity that we are placing per order, divided by 2 times the holding cost. So in this particular, under the current policy,
Please.
yeah.
So how did you get the 16,000?
Okay. WQZ Co forecast that demand for product KN will be 160,000 units in the coming year, and it has traditionally ordered 10% of the annual demand per order.
Okay.
So the 10% of the annual demand is currently our economic order size. That is the quantity that we are placing per order. Economic quantity, what we are saying is that we want to determine the quantity that we have to place per order to minimize cost. So the quantity that you are placing per order is the economic order quantity. In this case, it is 16,000 for them. But under the new policy, we want to use what? Economic order quantity to determine the order size. So we have to come and do that. We first have to know that.
So that means,
yes.
So that means what we just did, we use the traditional method.
Yes, that is the current policy.
So
we
the
are now
first
coming
one
to
is the traditional. So now, economic order quantity.
That is the new policy.
Oh, okay.
Or you
okay.
can make it
So,
old policy. That is the current can be old policy, and the new policy is the one that we are coming to do. They are now saying that they should use economic order quantity. Sorry. We have holding cost. We have to add the buffer stock to it. Sorry. The buffer one. So the holding cost will be the usual one plus the other quantity that we are holding, which is what? What is the buffer inventory is what?
5,000.
5,000
5,000.
times the holding cost. 5.12. All right. So what will be the total answer?
53,760.
Okay.
Yeah, so if I'm getting unit, that means that the traditional method, we mostly not get a purchasing price per unit of the cost for purchasing per unit.
Come again.
If I'm getting you the traditional method, there will be no purchasing cost per unit.
There will be a
Like
purchasing
the
cost per
purchasing.
unit, but the purchasing cost per unit will still be the same as if you are changing the policy. If you are paying 12 cedi per unit and you want to increase the order, does it mean you are not going to pay the 12 cedi per what you are buying?
You
You just saying that, okay, I'm buying 60,000, but every order bring me 5,000. Are you okay? But if you want to increase the order to 10,000 now, it doesn't mean that you will not pay the 12 cedi for everything that you are buying.
okay? So if you are having the same like the same question, but we also have the purchase cost to be 12 cedis, will it be the 160 divided by the 16 times the ordering cost times the price?
You said if you be what? If you have
If we are giving a purchase price like the first one like 12 cedis,
yeah,
and then the same like we maintain everything, then the question
okay.
I'm asking whether the purchase cost will be the 160 over the 16 times the
No.
ordering cost.
That is the okay. That the purchase cost will not be the purchase cost will not be 160 divided by 16. That is ordering cost that you are getting.
Okay.
That is the ordering cost. But if the purchase price will just be the quantity that you are buying multiplied by the amount that you are paying for each quantity.
So,
It will be 160 times 12.
so where there is a buffer inventory, you use the formula of maybe economic quantity over 2 plus safety inventory, right?
Yes. Joycelyn,
Yes. Then I
let's get
think
this. Austin, I'm coming. Joycelyn,
Yes, sir.
purchase price is the amount that you are paying for the goods. That is the purchase price. So
Yes.
if you are buying 160 and one quantity is 12 cedis, how much are you going to pay for the 160? It is the 160 times 12. That is the purchase price.
Yes.
Are you okay? But if you are coming
Yes.
to if you are coming to ordering cost,
Mhm.
ordering cost means that the cost given to us is per order. So we have to know the number of orders that we have done so that we multiply it by the cost per order. Our annual demand is 160,000.
Mhm.
Every quantity, every order, we are ordering 16,000. So how many orders can we place to get the 160 if one order is 16,000? That is how can we have the annual demand divided by the order size times the ordering cost. But the purchase price is the quantity that you are buying multiplied by the price per each quantity. That is the purchase price.
Okay.
Are you okay?
Yes.
So if you have 12 cedi over here, to be 160 times 12, that will give us the purchase price. Then you add the holding cost and then the ordering cost to it to have the total cost. But since we are assuming that whether you change the ordering size or not, you are going to pay the same amount for the quantity that you are purchasing. That is why we ignore the ordering cost. And that one is no, the amount is not given to us. That is why we are not using it. If the amount should be given to us, then we use it. All right.
Okay.
Yeah, Austin.
yes.
Okay.
So I was like, where there is a buffer inventory,
Yes.
the formula will be economic quantity over 2.
Yes.
Then you add the safety inventory.
Then you multiply the
Before-
answer by 5.1 plus the
Yes.
holding cost. Yeah.
Yeah. So I think there you will be 66,560 rather.
Okay. 66
560.
Okay. When there is a buffer stock, what we do is that you are holding additional costs in addition to what you should have been holding. So that buffer stock over is additional stock that you are holding in addition to your normal economic order quantity divided by 2 that you should be holding. So what we do is that when there is a buffer stock, we find the economic order quantity divided by 2 plus the buffer stock. Then we multiply it by the holding cost now. So you can see that you have a buffer stock of 5,000. So what should have been the actual inventory that we should be holding? It will be the 16,000 divided by 2, but we are holding 5,000 in addition. So you add the 5,000 to the actual one that you should be holding, multiplied by the holding cost per unit. Okay, let's come to the new policy. The new policy, we are using economic order what?
Quantity.
Quantity. So we first have to calculate our economic order quantity to know the order size before we can move on. So this will give us 2 multiplied by what?
400 or 400.
400 times the annual demand. Annual demand is what?
160,000.
160,000. All divided by the holding cost. And then you find square root of that. Holding cost is 5.12.
12.
Okay.
There 5,000.
5,000.
It's 5,000.
Yes, please.
Okay. Economic order quantity is now what?
5,000.
5,000. You know what is going to happen here?
Mm.
What will happen is that our ordering cost will increase and our holding cost will decrease. That is the effect. If you are increasing the order size, it means that you are going to place lower order to get the goods. So the ordering cost will reduce, but the holding cost will increase, because if you do divided by 2, the order size is now higher, so the average will be higher. So that is what happens. So let's check that. So the cost under the new policy will be, ordering cost will now be what?
Then ordering cost will increase, right?
Ordering cost will now be, how do we get it? How do we get the order now? The order size will be what? The number of order will be what?
160
16.
160 divided by,
5,000.
multiplied by what?
Multiplied by
400.
400.
Is it
400.
400?
So we now have to find the number of orders that we are going to place for the 160. If every order is 5,000 units, what will be the answer then?
12,800.
12,000.
800.
$12,800.
Mm.
Okay. Let's come now to our holding cost. Our holding cost will now be the economic order quantity 5,000 divided by what?
Mm.
Divided by 2
2 plus what?
plus 50. The
Plus the buffer, which is
stock
5,000.
inventory.
Then we now multiply our answer by the holding cost per unit.
5.12.
Okay. So how much are we getting?
17,800.
17. No, I'm getting
Yes.
You get 38,400.
yeah, that's what I'm getting.
Okay. Yeah.
38.
400.
Okay. So let's now find our new cost. What is happening?
51,000. Then has reduced the cost of.
So should we accept the new policy now by using economic order quantity, or we should continue with the old policy?
You have to accept the new.
We have to accept the new policy, because the new policy will give us a cost savings of what? What will be the savings that we are going to make?
The reduction, there will be a reduction of 19,360.
Okay, that is cost savings. We are going to save a cost to that amount. Let's solve additional 2 questions. I've understood that solving maybe some number of questions with students will help them to understand what you are doing. So let's solve additional 2 questions. Let me go to the top and see.
Say wait to.
Yeah.
The ordering cost, the one that we had, the 12,800. I didn't get the explanation very well for the ordering cost there.
The ordering cost is what is the total unit that we want to buy?
160.
Okay, we are saying that, okay, for every order that we are going to give to the supplier, we are telling them that they should supply 5,000 to us. So how many times they can supply 5,000 so that we can get a 160?
Shall divide.
I'm asking you a question. How many
The
times?
person
Okay, you are right now, you are saying that you want the cloth that you want to buy for this year is 100,000 cloths.
Mhm.
Okay. And you are saying that anytime that you are going to call the supplier to deliver to you, they should deliver 1,000 cloths. How many times are they going to deliver the 1,000 cloths so that you get the 100,000 for the year?
100.
They will do it 100 times, isn't it? How did you get it?
I multiplied the I divided the 100,000 by the 1,000.
Okay, it means that you are going to play 100 orders to get your annual demand, isn't it?
Yes.
And that is how we do. So it is the annual demand divided by the number of order. If you're going to call them and deliver to me, how many quantities should they deliver? So how many times will this quantity be delivered before you get the annual demand that you want? That is the order size.
Okay. Okay.
Are you okay?
Okay.
So order size is always the annual demand over the economic order quantity, or the annual demand divided by the unit that you are ordering per order. Every order, how many units are you ordering? That will help you to know the orders that you are going to place to have the total unit that you want to have at the end of the day. All right. I hope the explanation is now clear now.
Mm.
Okay, let's move on. Okay, you see the question 10. Question 10A. I will come and confuse you with that one, but let me go to one that the confusion will be small. It will not be that much before we come to that part. All right. Even if you are confused, just accept it like that and move on. In this life, you have to move on. Question 6.
TNG Co. expects annual demand for product S to be 255,380 units. Product X has a selling price of 19 Ghana cedis per unit and is purchased for 11 cedis per unit from a supplier. MKR Co. A supplier, MKR Co. TNG places an order for 50,000 units for product X at regular intervals throughout the year. Because the demand for product X is to some degree uncertain, TNG maintains a safety, that's buffer inventory of product X, which is sufficient to meet the demand for 28 working days. The cost of placing an order is 25 cedis, and storage cost for product X is 10 pesos per unit per year. TNG normally pays trade suppliers after 60 days, but MKR has offered a discount of 1% for cash settlement within 20 days. TNG Co. has a short-term cost of debt of 8% and uses a working year consisting of 365 days. Required. Calculate the annual cost of current ordering policy. Ignore cost in this part of the question. B. Calculate the annual saving if the economic order is used to determine an optimal ordering policy. Ignore financing cost in this part of the question. C. Determine whether the discount offered by the supplier is financially acceptable to TNG Co. D. Critically discuss limitations of economic order quantity model as a way of managing inventory. And E. Discuss the advantage and disadvantages of using just-in-time inventory management methods.
All right. So the C part, that is under trayables management. So we not tackle that. Critically discuss the limitations of economic order quantity. I've said that already, so I'll just ask you, say it to me. Discuss the advantage and disadvantage of using just-in-time inventory management. I've said something about that, you say it to me. So I will just do a calculation for you. And we discuss the limitations and the advantages, then we move on to a different question. Then we now look at receivables management. All right. All right, let's come here. The selling price given to you is useless. Don't sometimes they will give you unnecessary information in the exam. Be sure of what you are doing, or just understand what you know. If they say economic order quantity, know the figures that you use. If they say what is the cost of inventory, you know what goes to the cost of inventory is the purchase price, the holding cost, and then the ordering cost. We don't use selling price for any of that. Don't go there and be confused that you are calculating this for. No, selling price over there is useless for you in this particular case. All right. So what is our annual demand for the product?
2553.
255,000.
Okay.
Great.
What is the purchase price per unit?
11.
11. What is the current order size for the company?
60,000.
Is what?
Order
50,000.
size.
50.
50,000. That is
50,000.
their current economic order quantity. Let's take it like that. Are we okay? Okay.
Okay.
The TNG maintains a safety inventory of product X, which is sufficient to meet demand for 28 what? Working days. The cost of placing an order is what? 25. And the storage cost for this one is 10 pesos. Storage cost, what are they talking about?
Holding cost.
Holding.
Holding cost. That is very nice. Okay. TNG normally pays, this is relating to the payable side. So TNG Co has a short-term cost of debt of 8% and uses a working year consisting of 365 what? Days. Have they given us the buffer stock level? Have they given us that?
No.
They just give us the days.
The day. So we have to calculate it ourselves, isn't it?
Yes.
Yes.
All right. So we are having 28 days, but the annual demand is 25,380. And this is for 365 days. So your buffer stock, what you do is that the buffer stock level is the number of days over the number of days in the year times the annual demand. So that will give us 28 days. Am I correct?
Yes.
Divided by 365 days times the what?
Times
The annual demand, which is what?
255,380.
255,380. How much are we getting?
19,590.
19.
1,090.
Okay.
0.79.
Just
So
make it
maybe
to the nearest whole number.
So 19,591.
Okay. 19,591
591.
units. Whenever you are dealing with unit and you are getting decimal, make it to the nearest unit. Right. Okay. So they say that calculate the annual cost of the current ordering what? Policy. Ignore finance costs in this part of the question. Okay, can we move on?
Yes, please.
Okay. So they are saying that we should calculate the annual cost, which is the A part. So our annual cost will now be, so based on our annual cost, are we giving information on the purchase price now?
Yes, please.
So we can do the purchase price too. Okay.
Yes.
At the end of the day, the purchase price will not do anything because the current the new policy, we are not changing the purchase price. So the price will still be the same. So you can decide to ignore it because it will have a zero effect. So the purchase price will now be equal to, what is the price per unit?
11.
11 times how many quantity are we buying?
255.
255.
380.
380 units. So what will be our
2,809,180.
okay? I'm coming. 2,000,000
809,000
809,000
180.
809,000 100 and what?
80.
80. Okay. Let's come to our ordering cost. What will be our ordering cost now? It will be the annual demand, which is 255,380 divided by our current ordering size. What is our current ordering size?
50,000.
50,000.
50,000. Multiplied by
Multiplied
Ordering-
by
ordering
25.
the ordering cost is what? Cost of
25
placing an
cedis.
order is 25 cedis.
25.
Okay. Are we okay?
Okay.
Okay. What will be the total? What will be the total figure?
$127.69. So 128.
I'm getting 127, 128.
Yeah, 127.69. So 128.
Okay, 128. Okay. Let's come now to our what? Holding what?
Holding cost.
Holding cost. Our holding cost will now be our
50,000.
current ordering size, which is 50,000 divided by what?
2.
2 plus our what?
Buffer
Buffer
inventory.
stock level. What is our buffer stock level?
9.
19591. All of this will multiply by our holding cost per unit, which is 0.1. 10 pesos. Am I correct?
Yes.
Okay. How much are you getting?
$2,695.
I'm getting, if you do it, I'm getting 4459.
So, and then I think
It will be 25,000 plus 19591
195.
times 0.1.
591.
I'm getting 4459. 59.
4459.
Okay. So let's put them together.
Yes.
So what is our new policy now? What is the policy that they are asking us to use?
Economic order quantity.
So calculate the economic order quantity on yourself using this information. The rain wants to do something here. So let me find a place and see.
$10,300.
You get what?
11,300.
Someone should confirm.
$11,300.
Okay. All right. So our
So I didn't see the figure very well for the holding cost.
Joyce, your network is down.
Sir Linus,
Yes.
hello. Sir, the
Yeah, I can hear
holding
you.
cost, I didn't see the number that you multiplied as the holding cost. Is it the 10 pesos?
The holding cost.
Yes, is it the 10 pesos for the storage cost?
Yeah, it's a 10
Yes.
pesos. The storage cost is the holding cost.
Okay.
The holding cost
So
is
it's
part
0.1 or
yes, yeah, 0.1.
okay.
So whenever they say holding cost, well, they can also give you transportation cost. That can be the ordering cost, delivering cost, and those things. So holding cost is the cost that you are going to incur for keeping the goods or the inventories in stock. All right. Let's come to the new
Okay,
policy.
so when you are giving the transportation cost, Salinas,
Yeah.
please, if you are giving the transportation cost, are you going to add it to the ordering cost?
Yes, if you are giving, if they say the ordering cost is exclusive of the transportation cost, then you have to ask. Sometimes the transportation cost can be inside the ordering cost before they'll give it to you again. So it depends on the information given to you. All right. Or sometimes they can give you the list of the cost. So you have to know which of them will become part of the ordering cost. The ordering cost can be delivery cost, material handling cost.
So
Material
that
handling
means there
cost
could be
is holding cost. So ordering cost, they can give you transportation, delivery, order processing cost. Then you put all of them together and have your total holding cost. All right.
so that means there could be a situation where like the cost of transportation is 25.6 without not mentioning order. So we use that one for the ordering cost.
Yes, you can. If they can give you a transportation cost, then you ask yourself, transportation cost is associated with what? Is it holding or ordering?
Okay.
So you can see that you are giving storage cost over here. You have to know that storage cost is part of the holding cost. All right. Let's come to
And
the new policy.
transportation to be part of the storage.
You said?
Holding, or I'm saying that when they give you transportation, that one will be part of the holding cost.
No, transportation is we are not. Holding cost is the cost that we incur to keep the stocks to keep the inventory in stock. So if you are keeping the inventory in store, we don't incur any cost of transportation. Transportation will be when you are receiving the goods from the supplier. That is the ordering. Transportation will be ordering.
Okay, so like the guy was saying, maybe they will not give us placing a cost is 25, but they'll say maybe cost of transportation is 25. So you should
Yes,
know that.
or
Okay,
they can say
the cost for
delivery
ordering.
cost is 25.
Yeah,
Okay.
saying that because here you see they didn't mention cost of holding, but I was like, and
Yeah.
storage cost. So that means could be a case where they will not mention ordering cost, but they will be like
Yeah.
cost of transport. So you should know that
Okay.
maybe transportation is falls under ordering, then you use it for ordering.
Exactly.
Yes, I get it.
So then
All right.
must
Let's look at the new policy now. What is the economic order quantity?
11,300.
11,300 units. Do you approximate it?
Yeah.
Have we done any approximation to it?
No.
No.
That is the actual figure given to you.
Yeah.
Yes, please.
Okay, let's come to, you see, sometimes let's come to the cost of the new policy now. The first one will be the purchase price, isn't it? The purchase price will still be the same as the 11 cedi multiplied by the quantity that you are what? You are buying.
255,308.
This is 255,380. So you can see that the purchase cost is having a zero effect, isn't it?
Yes.
It is same for the two. So sometimes you can ignore it. We only consider the purchase cost when there is a discount given to us. It means that the purchase cost will now be different. So we consider the difference. But this one you can see that they are all the same for the two. So you can decide to ignore it. You can decide to ignore it for the two. We don't have any problem with that. And only focus on the holding sheet. Okay, let's come to the ordering cost. Okay, what will be our ordering cost now? It will be 255,380 divided by what?
Ordering cost divided by
255
11,000.
divided by 11,300. That is now our new order size. Multiply by 25. Am I correct?
25.
Okay.
Yes.
What will be the answer?
Answer will be 565.
565. Let's come to holding costs. Holding cost will now be 11,300 divided by 2 plus the buffer stock, which is 19591. All of this multiplied by 0.1. Am I correct?
Yes.
What are we getting?
2524.
2524.
2524. Am I correct?
Yes.
Okay, let's add it and see whether we should accept it or we should ignore. Do we accept or we should ignore?
We accept.
If you want to know, you find the difference. Which of them is higher? They are all cost. So the one that is lower, we accept that one. So you can see that the second one is what?
Lower.
Is lower. There will be some cost savings there. So you accept. All right, let's look at another example. I'll do introduction for the receivables management. Then let's see if we continue. Okay, they say something about those things, isn't it? Okay, discuss the what? Okay, the C part is for trade payable, so let's ignore that part. Okay. Okay, we say we should ignore financing costs in this part of the question. You see, sometimes this is the total amount of money that you are going to spend on the inventory. The old policy, you are spending 2,813,767, isn't it?
Yes.
This is the total amount of money that you are going to spend on the inventory, and you are going to take this money from maybe long-term liabilities or short-term liabilities. So if you are taking this money from people, you are going to pay interest on it. So sometimes you calculate the interest rate on it, which is the 8%. So it means that if you are going to take this money from someone, you pay interest of what? 8% on it. But they say we should ignore it. So we are not going to apply the interest on it and compare. So we should ignore. So sometimes when you are talking about interest, it means that if you want to do the investment in the inventories, this money will be borrowed from someone. Or if you are using cash, it means that if you should invest that cash, you will be getting 8% on it. So what is that interest that I'm going to pay? Or what is that interest that I'm sacrificing for investing in this? Sometimes we find it and add it to the cost of the inventory. find it and add it to the cost of the inventory as a finance cost. If you are going to take the money from someone, finance cost is also coming as a necessary cost to the inventory, because you are incurring that cost as a result of you are going to buy the inventory. So we sometimes apply the finance cost on it. So when you are given a question, after getting this, you can apply the finance cost on the total cost of the inventory, because this is the total amount of money that you are going to spend on the inventory. And where are you going to get this money? You are going to borrow it from someone. It means that you are going to pay interest of 8% on it. So you find the 8% as a finance cost and add it to the total cost. But that is not necessary in this particular place. All right. Let's look at the last one. Where are you? Okay. This one I'm going to confuse you with. Don't worry. Question 10.
PQA Co. is an European company that sells goods solely within Europe. The recently appointed financial manager of PQA Co. has been investigating the working capital management of a company and has gathered the following information. Inventory management. The current policy is to order 100,000 units when the inventory level falls to 35,000 units. Forecast demand requirement during the next year is 625,000 units. The cost of placing and processing an order is 250. Was Scatter another one?
As you come down.
But the scan on again is I'm lost. It's Scatter.
Can you see now?
No, it's
Yeah,
asking about the currency.
the currency is it
You said
what
what?
currency is it? The
The
name of the
currency
currency
is euros. It's euros.
euros. Okay. So cost of placing and processing an order is 250 euros. While the cost of holding a unit in stores is 0.5 euros per unit per year. Both costs are expected to be constant during the year. During the next year, orders are received 2 weeks after being placed with the supplier. You should assume a 50-week year and that the demand is constant throughout the year. Requirements. So I think the other one here is
Okay,
not
let's look at the requirements. Okay.
Requirement A. Identify the objectives of working capital management and discuss the conflict that may arise between them. B. Calculate the
I hope you can do that one. That part, that first one.
objectives of working capital.
Okay.
Is it not the first two that you said, and you said they conflict with each other?
Yes. Okay. Let's move on.
B. Calculate the cost of the current ordering policy and determine the savings that could be made by using economic order quantity model.
Okay, stop there. We are only looking at that part. Okay, so what are they saying? Is it the current policy is to order 100,000 units when the inventory level falls towards 35,000? So their reorder level is 35,000. So what is their current order size?
100,000.
100,000. And what is their total annual demand?
Total annual 625,000.
625,000. What is their reorder level?
Reorder level.
Okay, The real order level is there when the
35.
inventory level falls to 35,000. So at the 35,000, then we reorder the quantity. That is the reorder level.
So the real order is 35,000.
Okay. So the cost of placing and processing an order is what? 250 euros, where the cost of holding a unit in store is 0.50 euros per unit per year. Both costs are expected to be constant during the next year. Orders are received 2 weeks after being placed with the supplier. You should assume a 50-week year and the demand is constant throughout the year. Okay. So you should calculate the cost of what? The current policy and then the old policy if you're using economic order quantity. This is very interesting question where my people will just stand up and be doing what they want to do. But this is also a technical question. You see, okay, we are saying that it is normal for company to maintain reorder level. Whether you maintain the reorder level, the holding cost will still be the same. But whenever you maintain more than the reorder level, it means that you are holding a particular. I will finish right now. You will see. I'll be okay. So whenever you are keeping a stock level higher than the real order level, then it means that you are keeping what we call a safety stock or a buffer stock. So this particular question, what you are going to do is that you have to find your actual reorder level. Actual reorder level. Reorder level is the maximum lead time. The lead time over here is 2 weeks. The time that it takes for us to place the order and receive the goods, that duration is the lead time. What is the annual or what is the weekly demand? What is the weekly demand for the company's products? What is the weekly demand? What is our annual demand? What is our annual demand then?
Annual demand is
100,000.
5,000.
No, that is the
625.
100,000 is the order size, annual demand.
625.
One is 625.
Okay, this is question 6. Let me put the question 6 there. Question 6A. Before I will convince you, then you go to the house. Go and sleep. Okay. So let's find the weekly demand. Weekly demand.
4,500.
If our annual demand is 625,000 and we have 50 weeks, so how much will be our weekly demand?
4,500.
It will be 625,000 divided by what?
50.
50. What will give us our weekly demand?
12,500.
For
12.
okay, 12 what? 500.
500.
So our weekly demand is this 12,500 units. So if a week we are demanding for 12,500 and it's taking us 2 weeks to get it. So our reorder level should be the 2 weeks times our weekly demand. So let's find our new reorder level now. What is our reorder level? Actual reorder level will be what? The lead time, the number of weeks that it takes us to get these times, the quantity that we should be demanding for a week. So that will be 2 weeks multiplied by 500. How much are you getting?
25.
You're getting what?
25,000.
25,000. Am I correct? Am I correct?
25,000.
25,000. This is supposed to be your reorder level. But what is the reorder level in the question given to us?
35,000.
So what is happening? There's a buffer stock of what?
10,000.
10,000. So you find a buffer stock of 10,000. Which is a 35,000 minus the reorder level, which is 25,000. So we have a buffer stock of 10,000 units. Okay. So let's now come to the cost under the new policy. So the cost under let's look at the current policy first. Current policy, the cost. Do you have purchase price in the question? You have purchase price.
No,
So
no.
we assume that nothing is going to change for the purchase price, whether you are buying 10 or 10, the cost will still be the same. Are we okay?
Yes.
We will not consider that. So the first thing that we are going to consider is the ordering cost. What will be our number of orders? It will be the annual demand divided by the current order size, isn't it?
Policy.
So which will be
Yes.
625,000 divided by what? Divided by 100,000 times our cost per order, 250. How much are we getting?
250.
We are getting two. Are you sure? I'm getting 15, 62.5.
63. 1563.
Okay. Because this one is just one decimal place. Let's just maintain the 0.5. Okay.
Oh, okay.
Let's now come to our holding cost. Our holding cost will now be equal to the order size, the current order size divided by 2, isn't it?
Yes.
Plus the buffer what? Stock. The buffer
Stock.
stock is 10,000. All this multiplied by how much?
0.5.
0.5 euros. What will be our total answer?
I think times
30,000.
30,000.
it's supposed to be times.
So what will be our total cost under this now?
31,562.
31,562.
Right.
Am I okay?
Yeah.
Okay.
I think the holding is supposed to be times 0.5. He did it
That-
plus. With a calculation for holding costs, you did
It's
it.
times.
It's
Your
time,
first-
so.
It's
your
going
first
to be
is not-
17,500.
Yeah, but I think you have to. Let's check it again. You did it plus.
Austin, come again.
I mean, calculation for holding costs. The last part is times 0.5. You did it plus.
Yeah,
So maybe
it's 0.5. I've added it.
It's multiplying.
It is
multiplying, not-
multiplying. Sorry,
yes,
sorry,
not
sorry,
times.
sorry. Okay. Okay. Can we move on to the new policy now?
Yes.
The new policy, what are we using? We're using economic order what?
Quantity.
So we need to
Quantity.
find the economic order quantity. So let's find that. What are we getting?
25,000.
Okay. So our economic order quantity is now 25,000. Okay. So let's find the cost now. Let's find the cost under the new policy. Cost. The first cost is the ordering cost. So what will be our ordering cost now?
The bring cost to be
How do you
the
get it?
demand. Demand. That's 625,000.
Okay. So say it again.
The demand over economic quantity. So 625,000
Divided by
25,000
25 times
times 250.
250. Okay. How much are we getting?
1,250.
2,000,
6,250.
6,250. Okay. Let's count to our holding cost.
economic quantity over 2 plus
No,
safety
25,000
25,000 divided by
divided by
plus
2 plus the buffer stock
10,000
10,000. All this
10,000.
multiplied by
is
0.
0.5.
0.5.
How much are we getting?
Eleven
11,250.
250. 250.
11,000.
250.
Okay. Let's add.
17,500.
17,500. Should we accept? Should we implement a new policy?
Hi, Sir Linus.
Yeah.
Please, can you go up for me? I want to see the first policy. Okay, so 15. This one is 30,000. This one is not supposed to be 30,000.
It's supposed to be how much?
The holding cost
Yeah.
supposed to be 17,500. Oh,
Oh,
No.
because too much. Oh,
because it is multiplying.
Isn't it 100,000 divided by 2 plus 10,000? What you get times 0.5?
100,000
Oh.
divided by 2 is what? 50,000.
Please let me
yeah,
check
Plus-
again.
yeah, 50,000.
Then we add the
Plus
we add the buffer
10,000.
stock to it.
Okay.
Then we
So
multiply the
60,000
percent.
10,000.
10,000.
Are you okay now?
Yeah. Yeah,
Yeah,
sure.
0.5.
So should we implement the new policy or we should avoid it?
We should implement it.
All right.
Yeah.
So ladies and gentlemen, this is about you see the first time the inventory management came May 2021. That was the time. After that time, now they brought cash management twice. They brought receivables management maybe 3 times or something. They brought it last sitting was receivables management. So the inventory came only one. So maybe anything can happen. That's why I wasted my time on this. We still solve the receivables to maybe like two examples.
That means this one can drop on cash management.